What a difference between the contract in Islamic banking and conventional banking. Let us understanding what the major difference between Islamic banking and conventional banking. Islamic banking is an ethic banking system and its practice are based on Islamic Sharia law. Interest in completely prohibited in Islamic banking. It is asset based on financing, which is trade of element be is Islam or not allowed. Okay, for example, you cannot take a loan from the wine shop because wine shop is Arab or prohibited in Islam. Okay, on the other hand, conventional banking is an ethic banking system based on the man-made law. It is profit oriented in purpose to make a money through the interest. Okay, I will explain more about the difference conventional banking and Islamic banking. Okay, conventional banking is offer lending facilities to their clients to fulfill their cash requirement on the basis of the loan contract, where the relationship between the banks and client is that of the lender and borrowers respective. Okay, conventional bank have three characters. Okay, one, no risk of the underlying assets. 2, income through interest. 3, late payment charge on delay payment and shall constitute bank income. Okay, for Islamic banking, Islamic bank offer the financing leasing facility to their client to fulfill their business requirement on the basis of the following contract depend on the requirement of the client. There are 5 characters of the Islamic banking financing transaction. Okay, firstly, Islamic banks take the risk of the asset. Okay, 2, income is earned through the sale or leasing contract. 3, share profit bear as the case may be. Okay, 4, in case the late payment or default by the clients, there will be not penal charge. However, to instill a payment discipline, bank is authorized to recover an amount at a predetermined percentage as compulsory contribution to the charity funds constituted by the banks approved by Sharia boards. This contribution to charity funds shall not constitute income of the bank. Okay, 5. The bank will deploy the Islamic fund in only Sharia compliant avenues. Okay, when a sale and buying back agreement, or we call BBA, house financing was first introduced, total cost of the property purchasing was determined at the point of the contract, as we know as akad. If an individual wishes to purchase house for $500,000 or 500,000 ringgit, the bank would buy the property at the 500,000 ringgit and sell it back to the customer at price 850,000, which is give the bank a profit 350 ringgit. The total of the 850 ringgit would be paid over the duration of an agreement number of the year started in the contract. There were no fluctuation experienced on monthly commitment as how conventional mortgages endures. Over time, a financing institution realized it works as the disadvantages to customers who were locked in a very high profit rate or vice versa, where the bank could be facing very low profit rates. To counter the effects, they introduced a variable rate financing as how conventional interest rates floated, except this has a maximum caps. This works well is safeguarding investment and ensure commitment to do accept certain monthly amount.